All right. Hope everyone is doing well. Let me just make one adjustment really quick here. Okay, we should be good. So overall, let's take a look at the daily chart, and feel free to just go ahead and ask questions. I'll review them at the end of the day. So on the daily chart, we have consecutive bull bars from Thursday and Friday, and today is the doji. We went above the April 18th high and found sellers. And really, is this going to be some form of an expanding triangle here, here, and here? And actually, while I'm talking, I'm going to update the mouse. I know there's been comments asking for the pointer to be a different color. But to me, this is a pullback from the prior few days. Okay, that should make the mouse green. If it's white, make a comment and just say white. But anyways, two good bull bars, probably buyers below, scaling in lower. So bulls will buy, and they're going to bet on a second leg up. You have bears that sold the April 26 high, and they scaled in higher. And because of that, you have bears that sold the April 26 high. Interesting. I'm going to stop the share and try this because my mouse is green, but it is showing up as white. Let me just try one more thing really quick. Okay, great. So I had to turn off the screen share. Glad it's green now. Anyways, there's bears that sold this high right here. And they will likely, some of them scaled it higher, and they were so disappointed that they started buying back shorts. Other traders, what would they do? Well, there's a few ways some bears will manage this. Maybe they use a measure move. They sell and they put a stop way, way up here. And some of those bears will be looking to add on higher. They're not going to add on after consecutive strong bull bars. They want a second leg up and for the leg to stall. So therefore, if the market goes down, a lot of those bears will buy back shorts. You have bulls trapped out of a trade. They did not buy as the market was going up on the prior 2 days. So what are they going to do? Those bulls are going to look to buy. any pullback they can, betting on a second leg. So right now, to me, the first reversal down will be minor, and we're probably going to get a second leg. So there's probably buyers below today, buyers below Friday at a 50% pullback. Even if we get down to Friday's low, which is where my mouse is, there's probably going to be buyers down there. Those bears would be so disappointed that if they could get out over here, they would probably take it. But still early in the week, so plenty of time for more to develop. Monthly chart, we closed as a bull bar on its high. And in the past, really in 2 days, we completed the entire body of this month's bar. Let me just check one thing really quick. So that is certainly impressive for the bulls. 5-minute chart, pretty much trading range day. $4,200. There we go. First bar of the day, the market gapped down, and we can see on bar one, we had a gap and a bull bar. Bar one, it's a possible pullback from the 74 to 81 rally on Thursday, but the reality is, or on Friday, but the reality is there's probably buyers below scaling in lower. So some bulls will buy, but there's going to be bears selling up here, betting on a second leg down. There will be some bulls buying up here and buying a pullback. And why would they do that? Because they expect the market to go sideways. Surprise bar on 2. In general, when you get consecutive bull bars on the open, it's usually strong enough for buy the close. So reasonable to buy the close of 2, stop below 1, betting on a second leg up. So traders will buy, put a stop down here, and they'll bet on at least a small second leg up and buyers below. And then 3 is the doji. It's hesitating at the 81 low and the 81 close. So might be an area where traders are taking profits. And then 4, we got another big bull bar. Good bar on 2, bad follow through on 3. 4, a big bull bar. It's a breakout, but in a trading range day, probably going to have bad follow through. It's also a possible top of a channel. 12, somewhere in here, around bar 42 on Friday, and then a second leg up. Symmetry is not great. Here's 12, here's 42, so about 30 bars, and then 42 to about over here, it's 40 bars. But it is a credible top of a channel. And you could argue the bottom of the channel is somewhere around here. 5, a bear bar, closing on its low. Tight bull channel from 1, so probably buyers below 5 scaling in lower. What about exiting 5, betting that the rally from 1 to 5 is a leg in the trading range? It might be. This could be the top of a channel, and if it is, we could easily test the bottom of the channel and find buyers. So it's credible for traders they can do really one of 2 things. Some bears, some bulls, they'll get out below 5 and they will wait to buy more above a bull bar, especially if it closes on its high. Other traders, rather than exit below 5, they'll exit a measured move down of 5. Why a measured move down? Well, in general, and I'm going to scoot this chart over a little bit. In general, if you're going to sell below a bear bar and put your stop 1 tick above, a minimum scalp is the size of the signal bar. So if I'm selling below 5, stop above 5, it's reasonable to put a target something like that. So that would be a minimum scalp distance. And the argument would be if the bears can make a scalp, then that is probably we're not in a bull trend. Small pullback trends do not make scalpers profits. Look at this rally from over here, 19 to 44, somewhere in here. Look at every bear bar. We did not fall a scalp distance below. So If you sold below this bar stop above, it did not go 1 times your risk. Tight bull channels typically will not fall a scalp distance below. In other words, stop entries will not make money. And even when a stop entry does make money, the odds are it's in a trading range more than a trend. And here you can see what happened. The market sold off aggressively and it went well below 50% and started to find buyers back at the one high. So why did we hesitate at the one high? Well, we had a gap down from 81 to 1. So there's probably some bears selling the one high, betting that the bears would get a second leg. In other words, a breakout to the one open, and the bears wanted a second leg down. They got trapped on 2. So 2, the one high is support. You had bears selling the one high, betting on a second leg down. They got trapped on 2. Therefore, when 7 tests the one high, there's going to be some buyers. 5, 6, and 7 is a strong enough bear breakout, probably at least sellers above and a second leg down, but the sellers may not come in until above the 7 high, and the market triggered the high above 7 on 8. 8, it's a micro double bottom, but a 3-bar micro channel. Really, it's a 4-bar micro channel if you include the current bar. It's a big bar, big risk, probably more sellers above 8 than buyers above 8. So you'll have some bears, they'll sell the 8 high, stop above 5, betting on at least a small second leg down. It's possible we have to get a bull breakout to the 4,200 round number, but right now we have an obvious wedge. 1, 2, 3. Within a larger wedge, 1, 2, 3. We're so close to 4,200 that we may have to get there. So it's possible the market has to break above the 4 high. But right now, if I bought above 8, how would I manage it? I don't know. I think it's tricky buy. I think it's okay to get out of shorts above 8, but not that easy of a buy. The risk reward's pretty poor. And that's why there are more traders selling above 8. Now, the bears that sold above 8, some of them would sell and put a target down here around the 7 close. If you're a bear and you sold the 7 close and you sold more at the 8 high, you're probably interested in exiting around the 7 close. If you sell a bear bar, the close of a bear bar like 7, you want the market to race straight down. If the market hesitates and rallies instead, it's a bad sell to close bar and you're disappointed. If you're disappointed, that means you're in a trading range. Also, the same can be said for the 4 close. Bulls buy the close, disappointed down here. Think about it. There was no real reason for bulls to exit. They did not have a credible stop entry short. They had a bad follow through bar on 3 and another leg up on 4. But 5 is not really, it's still a tight channel. So there still should be buyers below. And because of that, there's going to be bulls. They buy below 5, they buy below 6, and they scale in lower, betting on at least a trading range. And if they're betting on a trading range, we should test somewhere up here and allow those disappointed bulls out. And that might be what is happening on 9. So bulls buy the close of 4, buy more at the 4 low or below 4, getting out break even in here. And then 10, we went to a new high, sold off. It's 2 legs up for the bears. 8, pull back on 9, and then 10, and then a pullback. Another wedge, 79, 7, 79, 5, and 10. But to me, it's probably forming some kind of a triangle and probably going to go sideways in here. And then 10 broke out, 11 broke out below 10, possible double top with 5 and 10. But since 10 is a bull bar, probably buyers below 10, scaling in lower. 12, an inside bar. We have a follow-through bar. It's a follow-through bar from the 11 breakout. But what is 11 breaking out of? It's breaking out below the 10 low, but it's not breaking out below the 8 low or the 7 low. So it's a good bar for the bears, but it's still pretty poor. And that's why there's buyers below 12. 12, as I said, it's an inside bar, so it's a low 1 short. But low 1 shorts at the bottom of a trading range often fail and lead to deeper pullbacks. It was still disappointing if you bought the 10 low and scaled in lower on 11. So you may have more sellers back at the 10 low on the rally to 13. Bears will bet on a second leg down from 11 and 12. And then 13 and 14 consecutive bull bars. For the bulls, they want a double bottom 7 and 13 and a second leg up from the rally from 1 to 5. 14 follow through for the bulls, but fairly tight trading range, so not really ideal. And then 15 broke below 14, reversed up. You could see bears that sold the 12 high and more higher making money. So that is good for the bears. And then 16, more traders giving up. We have a surprise bar, 16, testing above the 10 high and the 4 high. And now we have a wedge, 5. Now we have a wedge, 5, 10, and 16. And then 17, we have an inside bar. 16 is a climactic bar, so it'll bring on some profit taking. That's why on the open of 17, the market immediately sold off. But because the channel up from 13 to 16 is so tight, probably buyers below scaling in lower. And then we have a second leg up on 18 and then reversal down on 19. So 19 is a second failed breakout for the wedge top. And because of how climactic we've been over the past few days, if we look at a 60-minute chart, we had a gap up, fairly tight bull channel, in consecutive buy climaxes far away from the 60-minute moving average. Therefore, we're probably going to pull back fairly soon. Let me just fix. The minimize bar went away. Maybe I can do it like this. Just make the bars a little bit bigger. Anyways, we have a double micro. I'll drag it down so it's easier to see it. We have a micro double top with 17 and 19. Reasonable to exit shorts, reasonable to exit longs, betting on a pullback. We may have to test the 13 low and probably the open of the day, open of the week, which is the 1 low. We've not tested the open in several days, and it's pretty common whenever you're most days test the open of the day pretty regularly. 20, we have a bear bar, consecutive bear bars, tight bull channel. I think we're going sideways here. For the bulls, they have a small gap, the 10 close and one of these closes, the 19 close and the 20 close. But to me, probably going sideways. We're around 4,200, and this channel up is still tight. From here to here. So we have a tight bull channel. And because of that, I suspect that the market is probably going to have to go sideways. Now, if you're a bull and you bought the 16 close, how are you feeling in here? To me, you're probably disappointed. And if you're disappointed, bulls are trying to get out break even. You can see some traders buying the 16 close, disappointed 17, 18, and 19, trying to get out break even at the 16 close during 20. And then 21, we have a bear bar closing below the past several bars and closing below 16. Good for the bears, but still a lot of damage to undo. We've been above the moving average for 21 bars. Therefore, the moving average will act as support. 22, a give up bar, broke below 1, tested the trend line from below over the prior couple days. Probably going to try to get down to the open of the day. With 4 consecutive bear bars, probably sell the close and sellers above, but stop far away, probably somewhere up here. And if you're selling the 22 close, probably better if you can scale in higher. 23, bear bar closing on its low. We're so close to the open of the day that we're probably going to get there. The tail on 22 is important, though. It's a warning that bulls are buying as the market's going down. So there might be more buyers down here than sellers, at least for a scalp. Now, those buyers are mostly bears buying back shorts, and they're aggressive bulls buying for a scalp. And then 24 reversing up, came really close to the open of the day. Probably going to have to get to the open of the day. But at this moment, we haven't reached it yet. Because of the bear bars from 19 to 23, probably sellers above in a second leg. And then 25, we have an inside bar. Still probably sellers above. You can see 25 low is important. Look at the 23 close. Bears sold the close of 23 here. Disappointed 24. And look what happened on the 25 low. They started buying back shorts. And then 26, another bull bar. Probably buyers below 26. And at least a small second leg up. Give me just 2 seconds here. I was asking about the Brooks trading course. That's the only course that's affiliated with this YouTube channel. I just put the link in the description and you can find out more information there. 26 buyers below, probably going at least a little bit higher. And it's at a low one short after 3 consecutive bull bars. Typically, low one shorts are minor and they lead to small pullbacks. In other words, there's probably, let me get to where we are. There we are. There's probably buyers below for at least a small second leg up, but those bulls are buying for a scalp, which means you will have traders who buy below, scalp out. You'll have some bears that sell and scale in higher. So the odds are we're going to get a second leg down and fall below the open of the day. And we triggered the buy below 26 and reversed up. So we have a low one short that failed on 26 during 27. Now the problem for the bears is we have 4 consecutive bull bars and one of them has a high above 2 of the bars and this bar closed on its high. What about buying above 27, betting on higher prices? It's a low probability buy, but it's a possible trap for the bears. We have a strong bear breakout down to here. And this breakout is strong enough that it should get a second leg down, but it is possible that because of this sell-off, it traps bears into a losing trade. Let me do this real quick. I want to share a chart. Now I made this chart, but it's an example of several charts that are in the Brooks Encyclopedia. So if you want more information on that, I would suggest going there because you can get a lot of really good stuff. But let me just share something real quick. Here we go. I think it's you've heard me talk about this before, especially if you're in the trading room, but it is really important to try and build PowerPoint charts. Try and make slides. It is not pulling up the slide I want, but I can show an example here. By the way, someone asked about a trap. This is an example of a wedge. Wedges, they asked what resets a wedge. A wedge, this is a good example of wedge here, here, and here. And because of that, whenever you get a wedge, typically there's a 75% chance of a two-legged pullback. And 1, 2, 3, we got a bear breakout below this wedge. That resets the market cycle. The minimum expectation after a breakout is a second leg, which is what happened on this green box. We got a second leg down. However, that's the minimum. And we do not have to get 3 or 4 legs after a breakout. So typically, you get a breakout, second leg, and then the formation of a trading range. And then ultimately, this box right here broke below the range. But anyways, let me show an example of a trap really quick. I'm just looking for a second leg trap. Still need to work on organizing this. But here's an example of the trap. Strong sell-off, but bottom of a trading range, possible second leg trap from 1 and 2. And you can see, as strong as this sell-off was, we had an extremely deep pullback and then ultimately retested the lows. So today, you have to wonder about if we're going to get a second leg, some form of a trap. So a strong sell-off, extremely deep pullback, and then a retest below. 28, a doji, possible low too short, but doji signal bar, probably buyers below. To me, I think a lot of traders are buying back shorts here due to the risk of a possible upside breakout. 29, another doji, then 30, bull breakout above the past several bars. So right now, you have to wonder about a bull breakout of a bear flag. 24 through 28 should have been a bear flag. We got an upside breakout on 30, follow through 31, probably by the close going higher and back to 2100. Bear bar 32, but still probably buyers below scaling and lower, and then 34 and 35 consecutive bull bars. Somebody asked about, I want to answer this question real quick just because I see it. Ron asked about, there's a video in the Brooks trading course on creating end of day charts and marking it as a review exercise. I'm not able to locate it. Do you know where the video number is? Yeah, let me go ahead and just pull it up really quick. That is going to be, for those of you curious about the trading course, here is what it looks like. Here is the Brooks trading course. Well, that's actually the encyclopedia. Here's the trading course though. And 121 videos, 59 hours. That's just the fundamentals. Then the how to trade, 72 videos, 38 hours, basically 39 hours. But what you're looking for is, Ron, is the bonus videos under, it's right in front of me somewhere. Let me find it here. 5 steps to taking today's trades. It is video 13. And video 13 gives you a link. That's information about Al. Video 13 gives you a link, PowerPoint objects, which is how I make the PowerPoint slides for myself. So let's go back to the chart. So 30, 31, bulls giving up, resetting the count, probably going higher. And then 36, 3 consecutive bull bars, testing up to the high closes in 4,200. So probably buyers below scaling and lower. When you get a channel that's this tight, usually the first reversal down will fail. And remember what I said about over here? You will have a lot of traders who put a stop, a measured move down below the bar. So let me give an example. They'll trail a stop, a measured move below the size of 32 going down below every bar. And what they'll do is, as long as the bears cannot make money below a bar, a scalp, then they will stay in the trade. Other traders just start to take profits. And then when they see 37, a really big bar, there's nobody left to buy. The bulls, they're taking profits here. Aggressive bears are selling. If you're a bear and you sold here, you're going to be happy to sell more during 37 because it's allowing you to sell at a great price, And someone asked about strong bulls and weak bulls, strong bears, weak bears. If you're a bull, If you're a strong bull, you bought down here as the market was reversing, or you bought 30 and 31. When you see 36, that's a profit taking bar. Yes, 37. When you see 37, it's a profit taking bar. Yes, 37 will probably have at least a small second leg up. Thank you. Let me do it like this. You know what? Actually, let me do this. I hate when TradeStation does this because it sometimes the bar will minimize, and because of that, it's really annoying for situations like this. And when the button minimizes, when you open a window, you cannot close it. And it does not happen on my other computer, which is fairly odd. Of course, the mouse pointers fairly large, which makes this rather challenging. It's good enough for now. There we go. I'll make a note to not maximize for now. But anyways, 37. It's a big enough bar. Traders are going to take profits. 38 follow through, but possible wedge. I'm going to get rid of some of these lines. But possible wedge. So there's probably more profit taking up here in sellers than buyers. And then we have a bear bar, 39. If I'm a bull, if you're an always in bull, it's reasonable to exit below 39 this bar and bet that traders are probably going to take profits. 40 consecutive bear bars, testing the 37 low. Is it always in short on 40? I don't think so. I think the bears probably need to do more, but it's a warning that we're probably in a trading range. Bears sold the 19 high scaling in, making money. So that is certainly not ideal. And then 41, an inside bar. It's a high one buy, but consecutive buy climaxes 1, 2, and then 3. Probably sellers above scaling and higher, but we could easily test up to the 30 high. 42, a doji. Some traders use the bounce on 41 and 42 to sell out of longs. Other traders will sell above 41, betting on a second leg down after 39 and 40. And that's what's happening on 43. 44, an inside bar, and we went sideways for several bars. 46, breaking below the past several bars, but testing the high of 36 right here. So it's testing a breakout point. It's a possible second leg down from 39 and 40. So there might be more buyers below. And then the bulls have an inside bar. It's a second entry buy, 2 legs down. First leg 40, second leg 46. And this sideways was a pullback. 47 is an inside bar, and it's in the inside bar in a tight trading range. So it's not really ideal. And then 48, a bear breakout. 48 closing below the past several bars, past almost 10 bars. It's a strong enough surprise, probably at least a small second leg down. But the bears really, they need another strong bar like 23 or any of these bars before a lot of traders are going to be convinced that it's going lower. What about buying the close of 48? I would not. The odds are there's going to be at least a small second leg down. 49 is reversal bar. So it's a high one. It's basically the first attempt to reverse 48. You can call it a wedge, 40, 46, and 48. But the problem to me with buying above it is two things. One, it was reasonable to buy 46 or the 47 low and scaling lower on 48 or during the sell off of 49. What are you going to do if you're a bull and you bought the 46 low or the 47 low? You're probably going to sell out of longs. So there might be more sellers above the 49 high than buyers. And you can see we triggered the buy and sold off during 50, and 50 went one or two ticks below 49 and reversed up. When you're in a trading range day, I think a lot of traders that buy above 49 will put a stop maybe halfway a measure move down. So they buy above a bar here, and instead of putting their stop below, they'll put it 2 points below or maybe 50% of the way down, betting that there's more buyers below 49 than sellers. And that's pretty common when you get some kind of a wedge or a couple pushes down and you get a pullback and you get a reasonable bull bar to buy, but it's following a surprise like 48. 50-50 chance in general, if not higher, the market will trigger the sell below the bar and reverse up. But tight bear channel, it's a micro channel, bulls not making money for several bars. We triggered the buy above 50 and started to reverse down. Because the channel down is so tight, sellers above, and you can see when we tested the apex over here, traders started selling and bulls started taking profits. Probably buyers below 51 scaling in lower though, and you can see we didn't even trigger the buy. 52, an inside bar. This is really becoming a mess. We're forming a tight trading range in here and basically forming a trading range over the 37 and it's not what I wanted to do, the 37 and the 38 highs. So the range could be somewhere in here. But I still suspect we're going to try and break out to the upside and test the 38 close. 52 and then 54. And still, I mean, at this point, it's so tight. It's breakout mode. I would not do anything. And then 56 dipped below and reversed up. What about buying above 56? Probably okay. Still, you're buying in a tight trading range. So it's a low probability trade. And you know at least 40, probably at best 50-50. And you can see we triggered the sell below 56. And again, kind of the same thing over here. Good bar 58. And you can see 59. What happened? Well, some of those bulls that bought the 56 low and scaled in 58, 59, they used the rally on 59 to sell out of longs. So it's possible measuring gap here. And this might be where bears get trapped. The other thing to remember is when you have a tight trading range like here and you break below it 56, 57, it increases the risk of a second leg down. 60, a bear bar, and then obviously 61, everybody gave up. 61 is a climactic bar, and it's an emotional, I call them emotional bars because you see it going down and you've had so much trading range price action, traders are afraid to miss the breakouts. What do? They end up selling late right at support, the 24 low, open of the day, low of bar one, and it's a big bar. So rather than waiting for follow through or waiting to enter on a pullback, which is what most traders should do, they enter here and they have to wait through all of this. 62, bad follow through, possible trap for the bears. Whenever you get a trap, what happens is a trap is a strong breakout, and it's usually a second leg in a trading range or it's exhaustion. But what happens in a trading range is bears get a windfall profit and they start immediately buying back shorts. Bulls, they see a big bar, it's climactic, and they buy. And they buy betting that the follow through will be bad enough where they can at least buy for a scalp. And the bears, they see 62, they conclude it could be a trap. So they start trying to buy back shorts at the close of 61, which is why the market went below here and turned up. Often you look at this bar, the close of this bar, and it's 66.75. Low of this bar, 64 even. So you can see bears made a 2-point scalp. Just want to see one thing really quick. Bears are able to make a 1-point scalp selling below, but either way, some bears they sell, they try and go for 2 or 3 points, or they try and take profits at the open of the day. It goes below it and immediately reverses up. So more traders start to try and buy just above the open. 64, Inside bar, probably buyers below 64 for a small second leg. But because of 62 and 63, it damages the bear case. Still probably always in short after the 61 bear bar. So if I had to do anything, I'd still probably be looking to sell. And here, trying to do the same thing as this right here. But when you look at this, 24, good bar, inside bar 25, bull bar 26, and then another bull bar 27. And you have to ask, 64, it's an inside bar. We triggered the low one below 64 and turned up. But where are the bull bars closing on their highs? It's also a second leg down. We sold off on 22, rallied to the 23 high, sold off again. So this is a decent trend line break. Let me show it on a 1-minute chart. Right here. It's hard to see, but the market sold off here. 2 big bull bars, new low of the day, but found buyers once again. And that led to the bull trend. Here, strong sell off, first reversal attempt. We probably need a second leg down. Bears trying to test the 62 low, and finally broke below it on 74, but it's so late in the day. I would do nothing here. Tight trading range through here, that will attract profit taking. We're at a measured move target, high of 38, low of 60, projecting down. And like I said, 61 was a big enough bar that it should get at least a small second leg, and 74 is a credible second leg. And then we went sideways into the close. Somebody asked, Brad, could you explain how you apply always in? I heard you several times say that that is what you should focus on when studying Al Brooks. So I'm interested in any nuances you've learned. Yeah, always in is if you had to pick a direction, long or short, at any given instant, whatever you choose is the always in direction. So generally on the open, if it's all the first thing I look for is consecutive trend bars. So let's just go to let's do like this. Let me check one thing here. Here's just a blank chart of the Emini. We go to a random day. Gap up, bull bar, follow through. In general, you want to see consecutive trend bars on the open. So reasonable to buy the close, betting on a second leg up. Second entry short, tight bull channel, but it's a second entry short and it might be a trading range day. Therefore, it's okay to exit longs. Aggressive bears may sell, but tight bull channel, the reversal is minor. So the biggest thing you have to distinguish with always in is reversals. Is the reversal going to be major or minor? And here, this is a good example. In a trading range, trading ranges are filled with lots of minor reversals. And what's a minor reversal? A minor reversal is when the trend can easily shift from one side to an opposite side. So a trading range, typically you get 1 or 2 legs up and then reversal. So where's an example here? We get a 3 consecutive bear bars, deep trend line break, new low of the day, but then we go above this high over here. 3 strong big bull bars, always in long, but look to the left. Just an ugly trading range day. And then we get 3 bear bars and we completely melt the link. Is there a link to the trading room? Yes. You go to Brooks, priceaction.com. Keep talking about always in, but I'll share how to sign up in just a second. But anyways, always in. The key with always in is when you get a strong upside breakout, you have to differentiate, is it major or minor? So the way I do that is very simple. Use the moving average. Look at this. Moving average below, lots of bars below the moving average. It's going to take more for the market to reverse. We have here tight bear channel below the moving average for several bars at the breakout on a higher time frame led to lower prices. Here, above the moving average, below the moving average, above the moving average, below the moving average down here, 3 consecutive big bull bars, probably buyers below, but top of the trading range led to an endless pullback. But anyways, let's go to another day. So here we go. We gapped up 3 consecutive bear bars. In general, the tight channel up is fairly tight. And because the channel up is tight, probably going to be minor. So at the minimum, is it always in short? Might be, but this may just be a pullback from the gap up. So I'm weighing something that's major. Look at these bars, big bull bar, follow through. Clearly going to be always in long for a lot of bars. And to me, I like to try and think about it from the standpoint of, is this going to have a major impact on the market, or is it going to be minor and last for a few bars? So to me, these three bear bars, it's probably going to be minor enough for a second leg, but it's not going to be the dominant feature. And there you go. So we have probably sellers above, small second leg. Let's go a little bit forward. Starting to get a tight channel, so it increases the odds of sellers at a new high. So I'm starting to think about always in from the standpoint of bear trend from the open, maybe a trading range day. Thank you. Yes, please tell me when the logo's in the way. I keep forgetting. I'm just going to turn it off for now. Tight bear channel, probably going to have sellers above, but because of the gap, this might be a pullback. So I'm fairly neutral with always in. I'm waiting for something dominant. This looks like something that's good. Okay, let's see the follow through. Poor follow through. Probably a second leg up, but is it always in long? Maybe, but it's not that good. And now look right here, 3 consecutive bull bars, rally from here. It's probably always in long, so probably okay to buy the close stop down here. Continuing higher, still always in long. Now, channel's tight. Lots of buy climaxes haven't touched the moving average in a lot of bars. So for me, this is kind of one of those finesse things about the market. Sure, it's always in long, but do I want to pay this much? If the moving average is an average price, I generally don't want to pay this much. So a lot of traders start to sell, betting that they can enter on a pullback, and they'll at least wait for the moving average to get closer. Big bear bar, 3 consecutive bear bars, probably sellers above. Now, for me, I'm saying probably sellers above, but what I'm thinking about is there's probably going to be a minor second leg. So therefore, I'm thinking about, let's say the next 6 bars. I don't think the next 6 bars are going to lead to a new high. Therefore, I would not be in a rush to buy. That doesn't mean I want to sell necessarily, but for me, another way to put it is if I'm long, I don't necessarily want to be long after this because we could sell off all the way down here. It's 3 pushes up, consecutive buy climaxes. So might be better to wait. And then we get a bull bar, probably going to go more sideways. But you can see we got a second leg down. Now we have a second leg down at the moving average. Would I buy it? It's probably okay. But tight bear channel, probably going to go more sideways. Now we have a bull bar, and it's probably forming a trading range. So let's go to today because that is more relevant for everybody. From an always in standpoint, we have consecutive bull bars. I mentioned today, always in long. Generally, you want consecutive bull bars. So it's probably okay to buy the close, betting on a second leg, but top of the trading range. Boom, second leg. Now, if you want to be really, Forrest Gump about it, Al always says Forrest Gump would make more money than Albert Einstein. And the reason for that is Forrest Gump would keep it really simple. Albert Einstein would make it really complicated. But anyways, tight bull channel for the first 4 bars. let me just go back to the trade room. So you have the bar numbers for type bull channel. You can do one of two things. You can say, okay, I'm going to trail my stop. Now I get a bear bar closing on its low in what could be a trading range day. I'm going to exit below the bar and wait to buy a pullback. And you'd get out there, or you could get out a measured move down of the bar. Now, is it always in long, always in short? It's probably still always in long, but with 3 consecutive bear bars, it's not ideal for the bulls. So therefore, there might be more sellers above scaling and higher. What about now? Well, it's a trading range, so traders are selling above bars, buying below bars, and scalping. And then 16, bull breakout, but possible top of some form of a channel. So there might be more sellers above. Deep pullback, it's probably always in short, but possible bottom of a trading range. And the other way I view always in is you still have to think about it from risk reward. The lower you are in a trading range, the less aggressive traders will be, and the more they'll look to trade a pullback. We have a strong rally on 2, sideways on 3, a breakout. Because they think it's in a trading range, traders scalp out because they think the market's going to have a deep pullback. But anyways, I can talk a lot more about always in. The key, start with using the moving average. If you have a lot of days that are completely above or below the moving average, or a lot of bars, it's probably always in long. Here, always in long. Only thing you should be doing is buying. Here, three, 4, 5 consecutive bear bars, probably always in short. Wait for a pullback in a second leg, or sell for a second leg down. Here, very strong breakout. All you can do is sell a pullback, get short. And then here, bull breakout, all you can do is buy. Here, tight trading range, better to do nothing. Consecutive bear bars, always in short, but when you start to get smaller bars and you had a lot of trading range trading here, you always have to wonder if it's some kind of a trap. And if it's a trap, we could test all the way up here. Let me take a look at some more questions. Someone asked about, they requested a 2-day trial for the room. Do you know it'll be accepted? I wanted to get in to the room for tomorrow when Al is speaking, hopefully. Yeah, you should get an email on it. Do you often scale in with market or limit orders? I do both. For me, I try and trade limit orders when the market's going sideways, trade small and scale in, and try and sell closes when the market's getting bars closing on their lows or when traders get trapped. So here, it's reasonable to start buying, betting that the bears will give up, and we test up to here. So for me, it depends on how trapped our traders. My buying closes up here. It's not really ideal because the market's probably going to go sideways. You can sell here, but better if you can sell and scale in. Was it fine to sell below 64 or was it too early? I wouldn't sell below 64 because to me, you're selling right where the bears that sold 61 are disappointed. If you're low one shorts generally lead to buyers below and second legs. So therefore, most of the time, low one shorts are better fades than stop entries. In other words, they're better limit orders. They're better to buy. It's generally better to buy below a low one than to sell below a low one, especially in a trading range day when the market is at resistance. Can you give an example of a stop order trade you took and how you managed it? I bought somewhere in here. I think I bought the 27 close, a little aggressive, stop down here, and I was taking a chance that limit order bears were trapped. So if you're a bear, it's reasonable to sell and scale in, betting on a second leg down. But then you start to see this, and you think, oh no, big tail, deep pullback up to here. So we sold off, and then we rallied and sold off. And now we're rallying again. So it's basically a micro double bottom, down on 22, up on 22. down on 24, up on 24. And you have to wonder in a trading range day, you can easily go above the highs. So at that point, I think for me, if I'm a bear, I would exit and start looking to buy. So that is why I bought up here. As far as stop entries, I don't know if I took any traditional stop entries. Actually, I think I bought above 49 and used a wide stop. I think I tried to buy more around the 49 low, but I was too slow. Ended up just getting out up here around, I think around break even. But I mismanaged that. I bought above it. I, I was too slow at a stop, a measure move down on the bar, and I wanted to see the market react a little bit. And because I thought there was a chance we get crashed below, and therefore I didn't want to scale in. But I was a little too slow. I should have waited. I should have just hit buy the market when it went down and started to turn up barely, but I didn't. Can you explain when you buy or sell at the EMA? Do you wait for consecutive bars closing above or below the EMA? For me, it varies on the market cycle. In a strong trend, traders certainly buy and sell at the EMA. Strong, small pullback trend, traders are selling anywhere close to the EMA. Here, gets really close to it, traders sell. The problem with today is we have a tight bull channel, yes, but a lot of trading range trading in here. It's basically some form of a channel. So bull breakout of a channel. We had a trading range, pull back, second leg up. So it might be a second leg trap. If you're buying here at the moving average, it's buying after decent selling pressure, and the bears may get a downside breakout. So it's more dangerous to buy here. Green line is the open of the day. Yes. Was reasonable to buy below 49, stop below 49. It was reasonable to buy above 49, stop below 49, looking to get back to a new high. So it's reasonable to buy above 49, stop below, looking to get back to new highs. Yes. Well, let me restate that. It was reasonable to buy above 49. It was better if you can buy more at the 49 low because tight bear channel, there might be more sellers above 49 for a second leg down. Question: I go through seasons in my trading career where I'm more aggressive for a while, then I back down and trade more moderate to passive. I guess that wasn't really a question. How do you determine the minimum scalp and swing size for other indices? For me, it's just a matter of I generally will just look at gold for like a 60-minute chart. To me, it's a matter of well, actually I don't want to do that. But just the ES on the Globex. For me, I would just look at average bar sizes and context. So strong bull breakout, and if I see 3 consecutive bull bars and I want to buy, I'll just buy the close. And this bar, let's just say it's 7 points. So for me, I'll kind of just eyeball it, and for me, I'll try and maybe go for at least 7, 8 points. But it also depends on what I'm trying to do. If I'm willing to get back in on the next bar, I can go for a smaller target and get back in. In general, most traders should just swing trade. So here's a 60-minute, 120-minute chart of the dollar yen. Strong bull bar on the dollar yen. Buy the close, stop below, and go for at least 1 times your risk. So buy, stop below. You could scalp out here, or you could say consecutive bull bars. You take part off as the risk gets bigger and you move your target even higher. But for me, I try and use the bars. So I'm always looking at, I was to sell below this bar and my stops up here. To me, I try and think about what's one times the initial risk. And if I don't think I can achieve it, then I know that it might be better to do the opposite. If I'm buying the close of here, I'm trying I'm buying the close of, let's say, 30, or I'm buying the close at 27. My thought is we may try and test all the way back up here, the top of the trading range where bulls originally got trapped. So I'm willing to swing trade more. Was bar 8 a high one buy in real time? Yeah, it's a high one buy. It's a breakout pullback buy. And I mentioned above, I thought that it may not be, I thought it would have a small second leg up, but there might be more sellers initially because traders would be disappointed up here. Okay, last question, and I'm going to end this. Would it have been wrong to put a sell stop one tick below 51? Would it have been wrong to sell one tick below 51 here? I would not. I think tight trading range, probably buyers below 51. I would wait for a breakout like 57, 58, and 59, or wait and sell when you see 61 starting to collapse. All right. I hope everyone found this helpful, and I look forward to doing them more. And everybody have a good one.